welcome to this masterclass by Rich the Bull. Rich the Bull is by far one of the most intelligent and best traders out there at this moment. His executions are simply unmatched, the precision is insane, and he has been giving out the daily buyers for about 2 months now, right, Rich?
Yeah, about that, mate. Yeah, I
Man,
think I'm
what's the lock at now?
19-2. I think. Yeah. Oh,
Oh
sorry,
my god.
19-3. I'll say 19-3. Yeah,
Damn, 19 and 3. That's
yeah.
insane, bro.
It's not bad, mate.
Yeah, I
It's not
think
bad.
people are very excited for today's webinar. You're, of course, pretty active on the socials, but there's not much video content of you out there just yet, besides the OTK, of course. So this will be like an introduction, I think, for the majority of people to your voice and to the way that you internalize markets. So let's dive straight into it, bro.
Yeah. So what I was thinking was today was to show how we can use OTE to our advantage, and how we know that OTE is going to present itself more so than often. Because what it is, when people learn OTE, especially from ICT and a lot of other people online, nobody really explains how OTE really works and why. So the idea today is, I think some people learn better when they fully understand why something's happening, not just, oh, there's an expansion leg or there's a range, right? Pull a fib and then hopefully we'll get OTE. That's all anybody ever says. Nobody really explains the real reason for OTE. So if we look at yesterday's example, we had this big expansion leg, and now we have this big range. And if we simply pull the fib, we can see clearly OTE gets tagged. Now, we can use OTE as an entry, like ICT suggests, right? But what we can also do is we can use OTE as an actual target as well, or draw on liquidity as such. So we can enter here and aim for OTE. We don't just need to wait for OTE to form and then use OTE as an entry. I think a lot of people don't really understand that. So first, what I'm going to do is I'm going to explain just very quickly how this works, and basically the market makers, they know exactly how the algorithm works, right? We'll make this a bit thicker so everyone can see. Now, as we know, this is the leg. This is 50% of the leg, or equilibrium, right? The market makers, they hedge their positions. Every position they take, they hedge. So what they have to do is they have to offer sell positions and buy positions at the same time, right? So on this leg particularly here, as they sell, they are making money. But every time they've offered a buy position, okay, we'll do it visually. Every time they offer a buy position, that buy position is now in negative, right? And what they have to do is they have to keep offering them. So what happens is they just keep offering and offering buy positions, and they're constantly negative, negative, negative all the way down the leg, right? Well, then what happens is, as they get to the bottom and we start reversing, because the algorithm's programmed to go back to 50%, the market makers, they know that literally all they have to do is hold their positions until 50%. And not only will they squash all their negative positions, but they will also end up in profit by the time they hit this position. So here They've brought, right? Now, these 3 or 4 positions and these 3 positions cancel out all the losing positions all the way up here by the time we get to equilibrium. So, as we know, price comes back to equilibrium, and now they're back in profit. This is why OT is so important, and people don't understand why. They just say, oh, pull a fib, wait for it to hit that level, and we're done. That's not the case. Now, just so you do know, to hit 50% is actually, right, 50% of any leg. If you go through and back test, right, it's a 90% probability, right? So the reason this is good is because most people, they get greedy and they aim, right, for the other end of the range, which is fine if it aligns with order flow, right? But if you're wrong, this, even if your bias is correct, right, it'll only hit this target, right, 60 to 70% of the time. Equilibrium is 90% of the time. Now, if you're wrong, this is not going to get hit anyway, either way, right? But with OTE, if you're wrong, this is still going to hit 90% of the time. I hope you realise what we've just said to you there. This is golden information. So simple, right? Maybe for some of the intermediate to professional traders, they're already in the know, but this is how it works. So what I'm going to do now is I'm going to give you a live example so you can thoroughly understand what's going on, right? This is yesterday's price action. This is a brilliant example. We will go down to the 5 minutes. We'll rewind first, in fact. And we'll go down to the 5 minute. And we'll simulate exactly what I just said, right? So the market makers here, although they know we're going short now, right? They still have to, I can't show buy and sell positions with the rewind tool before anyone says like, oh, you know, why aren't you showing us buy and sells? So what I'm going to do is, obviously, the sell positions, the market makers are winning money, right? They're making money. The buy positions, they're losing. But watch how it works, right? So they buy a position, right? Then they buy another position. Don't forget they're selling at the same time, but the sells that they do are winning because they're hedging, right? They buy again. They buy again. Now look, the negative, completely negative. What I'm going to do, I think I'll zoom in slightly just to make sure that it's very clear on the video. So as you can clearly see, the negative now, right? Which is not what they want. Excuse me. So we'll keep playing price. Okay, they keep adding, and the negative, clearly negative. So now we wait for that level to get broke before we start adding again. Bear with me, wait for news. Okay, so now news is gone, they're still buying, still negative. Then they buy again, they buy every swing. And as you can see now, they're back in profit. And guess what? This is going to be just past OTE. They only have to get to OTE to get back in the green. And this is how it works. And this is why OTE is so important. And this is how it truly works. So the market makers, they know that price is going to come back to 50% no matter what, at least 50%. And that, guys, is a 90% probability, just so you do know. Right. So, how do we take advantage of this? I'll show you right now. We'll get rid of that. Like I said before, we can use OTE not only as an entry, okay, but also as a target. So if we took this liquidity purge down here, this is at night time, obviously Asia session, so for the people trading New York session or London, that would not appeal to them, but it's still a possibility. We could enter right down here and we could hold all the way to OTE, and then we could start looking for a reversal after OTE. Same with the news. News candle comes down, takes all liquidity on sell side, comes back up, retests the midnight open, the true open, and then goes straight to OTE. Okay. Another interesting fact, which you can go and back test, is look what happens here. Consolidation. Consolidation always happens at equilibrium. Okay. Now, some of you are going to say, okay, now you need to pull like ICT's fib with the 70.5 measuring tool to try and find this reversal. Or you're going to ask me, Rich, you know, how do I know that it's going to reverse there, right? So what we do, firstly, as we all know, we're going to check the time. So we're going to see where we are in time, okay? If we're at a specific time, if we've got SMT, if we've got a market structure shift, right, what you can do is this hack, right? What nobody teaches anywhere. And that is all ranges are fractal, right? And what I'm going to show you now is actually a game changer to check your idea, right? And it's as simple as this. You fractalize the range to find the entry. So you think this first reversal here, or what looks like to be a reversal with CSD, could be the move, okay? What you simply do is this. You just fractalize the range, right? And you fractalize it again. Okay, now you can see we're over 50%, but then watch what happens, right? This happens over and over and over again. Look at the accuracy in that. So now we fractalize the range and you can see exactly where the reversal should be. Now there's a little bit of source for you. I'll leave that with you guys to back test. I'm not going to go any deeper into that right now. So, more proof of OT and how it works is simply this, right? ICT, when he was explaining about discount and premium, was very overlooked, okay? And even with your entry, we'll call them patterns, okay? Entry patterns or entry models, you can use OTE, right? And if you look, if we measure this expansion leg, look at the entry. The entry is exactly OTE. And for those of you that just say, oh well, that's just lucky that I picked that one, well, in exactly the same trade, there's another one right there. We hit OTE, price goes up, expands, comes back down. Like ICT says, we need to go down before we go up, or we need to go up before we go down. And this always happens. They always reprice to take profits here because of the positions, because here the market makers will be sell, and they'll be well in debt. They know that the algorithm's going to come back for them, so when they sell, they're back in profit again, ready for the next move. And this is all price does day in, day out. backwards and forwards, giving the market makers chance to either A, break even, which is unlikely, or to make a certain percentage of profit on top of the losses, the initial losses. And I think that'll do for OTE. I'll let you guys go off, back test that, and see what you think. I think they'll find that interesting, Zeus.
Yeah, I think so as well. I wonder, Rich, when it comes to OTE and when it comes to ranges, you always had this saying that price will always go to equilibrium, and that if you know that the opposite side of the range gets taken out, you can anticipate price to drop back to equilibrium. How do you utilize that? How do you utilize that information?
Say that again. What do you mean? Like, repeat the question, mate. Sorry.
Well, for example, your trade on this day,
Yeah.
on the afternoon session, you went short at the exact top.
Yes.
Why did you go short there?
Well, exactly why I was saying. So we're anticipating straight away, right? My order flow is bearish at the moment for this day, right? So I'm anticipating. We've got the range. We already anticipate what's going to happen once we've got the range. So there's OTE, and I'm looking for reactions after the equilibrium. So basically, I'm looking at time, right? We hit equilibrium at 11:40. So now, I'm not interested in anything until after 12. So basically, this is 11:40 when we hit the equilibrium. I'm waiting till after 12, so I will put a timeline in for 12, which is there. And now I'm looking for an open high on this next candle to go short, which we get. So basically, using the power of 3, we get open high, and then exactly like I told you, we get this first little fake market structure shift, or CSD, if we zoom in so you can see it clearly, right? We get this first little move here. Now, I don't like this because yes, we have a breaker here on a lower time frame, but we don't have a clear breaker in this price action, right? So I'm waiting. So now I'm anticipating that this move is the breaker. Okay, and then, like I just said before, what I will be doing is, behind the scenes, while this is panning out, I'm fractalizing this range, right? I'm then fractalizing this range. We see that we go over, and then over the equilibrium of this fractal range, and then we come back under. I know I haven't got a breaker, and I know that this is going to possibly be the breaker. We're at a perfect time. We're 12 o'clock. We opened high. I'm waiting for a flip of this candle's open. This candle's open was here. Make it red. And I'm waiting for a flip of this open, right? While I'm waiting for the flip of the open, I'm constantly fractalizing the range. And as soon as this happens, I know. As soon as we fractalize the range, the candles don't close above this level. We close below. And then we displace, okay, underneath the candles open. And the candles open, as you know, Zeus, and you teach well in TOTK, the open of anything is the true CSD, whether that be a 1 minute candle, a 1 hour candle, a day candle, a week candle, a year candle. The open is the true CSD. Then we get the touchback, we've got the breaker, we've got the unicorn model, right? And then price falls away nicely. Now, even if my bias is wrong, which I'm not overly concerned about, we're still going to get presented with a nice move. I'm pretty sure this was around 10 handles, if I remember, where I took profit on my futures account. Yeah, and it went 26 handles to the very low, which was nice. So that's how I would anticipate the entry, Zeus. I would fractalize the range. I would look at time, okay, and I would use the open high of this particular candle to go short, and that's exactly how I would do it.
That's lovely, man. A few weeks ago, I believe it was not last week but the week prior, I made a post on Twitter with regards to the following. You can trade ICT concepts without utilizing PD arrays. And you just showed how.
Yes, mate. I'm a big believer in that myself. Look, it doesn't matter how people perceive the market. The fact of the matter is that this is all 100% algorithmic, and although some people don't believe that, we prove this day in, day out, repeating, just doing the same thing, following the same logic. And if we look at these, let me clean this up a little bit. If we look, in fact, I can leave it open. I'm going to move these. If we look at time and we look at the range, because these are the most important things in my opinion, time, price and range. When we look at the range, we can clearly see this is an algorithmic delivery, 100%, because the open, like, and it's not random, is exactly at this area here, right? The same area where the BISI, the SIBI and the breaker all form, right? So ICT, as you've rightly said, he points out the PD arrays, right? But these PD arrays are forming because of algorithmic signatures, basically. It's proven, we've proven it day in, day out. There's more going on. And in this area here, Price is telling us that now we're going to change from a buy program, once this happens, into a sell program. That's a fact. And yes, we do not need PD arrays. I 100% believe that. I use it on a daily basis, mate.
That's a lovely answer, man. I think that many people can definitely look into that, because I feel that within the ICT community, this narrative has been created where it's just, oh, it's a unicorn, oh, it's a breaker, plus fair value gap, oh, it's this, oh, it's that. And by creating that narrative, there's now the issue that many people are simply looking for price patterns. They don't understand the narrative of looking at, for example, opening prices, the timings at which markets reverse, the signatures that are present that confirm reversals with regards to ranges, intermarket relationship, etc. So I think that what you just described is already something that people can look into greatly. Do you think you could maybe show another example of this?
Yeah, mate. Well, just to reiterate on what you just said, like for me, and no doubt for you and a couple of other people, there's only a handful of people that I ever talk about, you know, in the game. For us, it's very irritating when all we hear is these other educators, and all they ever do is they parrot the same conversations with everything. Somebody will say, "Why did this happen?" They'll say, "Oh, break a fair value gap." And say, "Oh, why did you enter there?" "Oh, break a fair value gap," and that's all you ever hear. "Oh yeah, it was a break of fair value. Oh, it's an inversion. Is it inversion fair value gap?" Not digging at anybody particular. Oh, it's a break. It's a fair value gap, and that's all we ever hear. Break a fair value gap. Break a fair value gap. Inversion. Break a fair value gap. And it's wrong. It's absolutely wrong, mate. It's crazy. Yeah, there's plenty. What example do you want, mate? What of an algorithmic signature like this, or?
Yeah, let's just go to another day and just see a trade that you took and maybe get like a saucy breakdown from the man himself.
Yeah, no problem, mate.
I think many people would appreciate that.
No problem. This was slightly different. So, if you look here, the breaker. So for some people, everybody's trying to like take the soup now and get in here, but for some of the very beginners, I wouldn't advise trying to take CSD entries, right? This is the 5-minute chart, by the way, so this is quite clear. You won't get in as early, but it's very safe. Okay, so here exactly the same thing happens as what I've just showed you, right? This is over a slightly bigger time range. Okay, notice how I said time range. So we have the breaker here, and if you look clearly, right, we're inside this BISI. As Zeus teaches in his lectures, right, this means that this is the intermediate term low because it formed inside this BISI. Okay, but what we do like is when the breaker, right, is the intermediate term low. This is a stronger signature, right? And yes, there is different types of signatures, there is different strengths of signatures. Okay, for example, this one, when we try and pull this BISI through, okay, it's not in line with the SIBI, but it doesn't matter because if you know what you're doing, these wicks, okay, where these overlap, this is no different than a gap. So where this wick and this wick overlap again, here, where you'll see the darker patch now. Oh no, you can't see. Let me make this lighter. Bear with me, guys. I moved this the other day. Okay, can you still see that, Zeus, on the recording? Is this too light now?
No, it's perfect.
Okay, I'll go a little bit darker. Okay, so where these two wicks overlap here, this is no different than a gap. Okay, so now what do we have? We have what we call nested PD arrays. And if you look where the very darkest patch is in that price action, okay, this here is like a balanced price range. Price should never come back to this area again, or it will retest. So all you do, you wait for the next candle to open. When it opens high, you enter anywhere in the wick. Now, the reason that's happening is because, again, this is an algorithmic signature that once price passes this area, okay, it's time to go. And if you look on this side, yes, we did have a very lower time frame breaker here, okay, but it's not significant. We do make quite a big move up. Then when we come back down, we can anticipate already. So what you guys need to do is, when you're watching price, when people say reading price, what you don't realize is when you read price, you need to watch the candles come down and anticipate this breaker to be made. Okay, so you could think it was this one at first, right? But as you see, price never displaces higher, comes back down, makes this breaker, then we displace. Okay, we displace higher. Now, when we super this high and reject, okay, we have this same signature, what I've been talking about. Okay, and when all this is aligned, this level here will not get broken until the draw on liquidity is met. So even if price wanted to go higher, right, even if it did, we have to wait for price to hit the target before going higher again. That's the only way it can happen. Price cannot reverse and it cannot switch, right, from a buy program to a sell program or vice versa until the draw on liquidity is hit. That's why sometimes you guys see me having a stop loss here, right, and then even when price comes down to here, comes all the way back up, I'm not scared, I hold it and I let price go again, because price cannot go into a buy program and take this high. This is a protected high until the draw on liquidity is hit lower. And these are all to do with the algorithm, all algorithmic signatures. And this is another perfect model of that right there. So for those of you, I'll reiterate quickly, you would see this forming, okay, this is the intermediate term low, breaker inside a fair value gap, perfect. Then we don't get a fair value gap here, because what we would like to see is this BISI closed by a BISI, and it didn't happen here, it happened slightly lower down. Okay, so this BISI was closed below, which would also give you the chance to re-enter again. As soon as this BISI was closed by this SIBI, closed past it there, you could re-enter there again. But for me, as soon as I see this breaker, okay, and I see this immediate rebalance scenario happening, as soon as this candle comes up, I can enter there. If I want to be secure, we can use the overlap here, which is just the same as another gap. Okay, and we can enter on the very next candle, either on the open or if it wicks up into this area. But either way, you can clearly put your stop loss here, and it will be safe. Another example, Zeus? Was that okay?
Yeah, let's keep on going.
Yeah, that's good.
I think many people that started watching this masterclass probably were like, oh, he goes on about OTEs. Oh, it's just OTEs. Oh, it's just, this price pattern, my ICT, dealing ranges, whatever. And some of them might have clicked off and they're all missing out on the sauce now.
Yeah, but the thing is, mate, this is what people don't get. Like, the average, like, look, and I know I've not been trading long, and yes, I've been very well trained, but education is key, and a lot of these educators out there, all they do is constantly repeat what ICT is saying, and I'm not saying that's wrong, because listen, ICT, as we know, is the man, right? He is the creator of 90% of what we know today. But ICT is very smart. He doesn't let the lazy learn. Okay, he makes people fight for the knowledge. So unless you really are prepared to dig deep, you're never going to find this information. And although some people complain about paying for discords, paying for mentorships and things like this, listen, for some people, if they don't have some kind of a mentor or somebody to look up to, they're never ever going to find this information, because they're blinded by all the idiots, and it sounds stupid, giving away the free information that's not real information. So, it's something for people to think about. They really need to understand what's really going on.
Yeah, of course. Yeah, I think it's also the way that ICT has structured everything that's just genius, where he just literally rented for like whole lectures, and then towards the end of the lecture just drop some very big sauce, and it's not for the lazy.
Yeah, listen, mate, you know as well as I do. Basically, you'll do a 3-hour video, and there'll be 3 minutes of very, very important high level knowledge that gets spilled through that video. And if you don't sit and listen, because like I said, ICT, he's got a only the strong survive mentality, and that's why, like you say, he's very smart. He structures it the way he does, because he doesn't like the lazy people no more than anybody else, mate. And I think he just thinks, well, if they're not going to learn, then they're going to be losers. That's it. You either learn or you lose. It's that simple.
Yeah, sick, man.
Yeah.
That's exactly how I view that as well.
Yeah. I do think that's the way he thinks, mate. I'll be honest.
Let's go to the next example, bro.
Right, so if I remember rightly, we have something. Yes, I think so. Let me just double check. Okay, perfect. So what happens is, in this example here, this one's a little bit messy, but I'm just going to showcase something to you now, which again, most people, and this is very simple, by the way, guys, but some people just miss the point, right? So here in this example, we don't quite have the fair value gap to the left, okay? So, but most people would see this scenario, right, and they would see this, what most would call mitigation block. I hate that word in trading. And most people will either A, not take it, or not really trust it. But what they failed to see was it's the same algorithmic signature as we've just been using, okay? And I reiterate, this isn't a real unicorn model like everybody says. A breaker and a fair value gap is not a unicorn model, and it is not a real unicorn, and it's not the unicorn that ICT teaches. And if your educator or anyone else you see on social media is telling you that, they are very, very incorrect, okay? Just so you know. Now, for those of you that get a little bit thrown off by these mitigation blocks, watch, I'm going to give you a very simple explanation for this. I would take this trade, okay? Yes, we can say that this one is a breaker here on a lower time frame. We have a low, a high, a low, a low, a high, a high. But I prefer to use the bigger structures which are more highly probable, okay? So when we look at this one and we're looking at it on like a 15-minute or a 30-second chart, it's not as highly probable as this bigger move and this bigger candle, right? This bigger candle is significant for a reason, okay? Now, here's the trick, right? We have a mitigation block, but we can enter like it's exactly a breaker, right? Why? Okay, it's very simply SMT, because on one asset this is a mitigation block, and on another asset it's a breaker. So if we look here on NQ, it's a breaker because we have a lower low forming here, okay? The low did get taken on Nasdaq because Nasdaq did not have the protected low. ES had the protected low, okay? And that's something we can learn about later, okay? So there is ways to know which lows won't get taken again and which ones will. In this case, it was ES, right? ES was the protected low. But what I'm trying to prove here is that because this is what, you know, most of the educators call a mitigation block, for me, it's not a mitigation block. It's still a breaker, because when you've got SMT, right, it's a breaker on other assets, which means it can also be used as a breaker on this asset when this asset has the protected low. I think that will give people something to go and figure out, Zeus.
Yeah, to think about.